Hey everyone, FinTech here. So SoFi just reported earnings for the full year of 2021, giving us a look into how the company is actually performing financially. But with things changing so quickly in the market and famous investors like Chamath Palihapitiya worried about a possible recession,
the next step beyond all of the supply chain issues could be a pretty bad recession if these companies have all this inventory and they don't know how to get working capital.
It begs the question of what's next for SoFi and how can they weather the coming storm of rising interest rates, inflation, and competition from other fintech startups, and will they be a good investment going forward? So in this video, we'll start by looking at SoFi's overall business model and how their three segments of financial services, technology platform, and lending all tie together. Next, we'll look at their earnings for their latest quarter as well as all of 2021. Finally, we'll use that information to tell us how SoFi will perform going into 2022, looking at their strategy as a whole as well as their projected earnings. And I'll also tell you at the end of the video whether or not I personally am investing more in the company based on these results. So hit the like button if you want, and let's start by going over SoFi's business. So let me tell you a story. It's a story about a SoFi customer named Kate. Now, Kate first heard about SoFi from their SoFi Stadium, which she saw featured prominently in the past Super Bowl, which she watched at a party with some friends. She later saw them again in a viral TikTok video, so she decided to sign up for SoFi Invest to finally start trading Tesla stock like all the YouTubers told her to. She ended up liking the app, so she starts using other financial services products, SoFi Money for her checking and savings account, SoFi Relay to track all her spending, and even the SoFi credit card, which lets her take advantage of their rewards program that pays both when you spend money as well as when you make good financial decisions, like putting cash back towards savings or investing, rather than putting it toward like a nice car. At this point, Kate is deep in the SoFi ecosystem, and they can use her data to better target her with products that fit her needs. SoFi realized that Kate is carrying around a little bit of credit card debt, so they offer her a personal loan at a much lower interest rate than her card. This gets her into SoFi's second business segment, lending. And because Kate has previously used their investing app, SoFi knows from their analytics that her lifetime value as a customer is double that of a loan-only customer, with a value of $1,600 on average. So they use that information to offer her a sign-up bonus when she opens the loan account. Now, Kate doesn't put all her money into SoFi. Like a good millennial, she gets some sign-up bonuses from a few different online accounts, and she keeps some money with an app called Chime, which is a mobile banking app. What she doesn't realize is Chime actually runs on the Galileo technology platform for its payments processing, which is a company that SoFi acquired back in 2020 for $1.2 billion, or what was then 10% of its total market cap. Galileo also happens to make up the third and final segment in SoFi's business, technology platform. And speaking of sign-up bonuses, right now WeBull will give you 2 free stocks when you sign up for an account. And if you deposit any amount of money, they'll give you another 3 free stocks. That's 5 free stocks in total, valued at a minimum of $27 when you open and fund an account. And you could earn as much as $9,600. Plus, when you activate WeBull Crypto and trade at least $1, you'll get a $5 crypto reward. You can sign up using the link in the description because it's literally free money. So take a second to click the link, open it in a new tab so you can look at it after you watch the video. You good? Okay, back to the video. So between these segments of SoFi's business, financial services as sort of a top of sales funnel, lending as their revenue powerhouse, and technology platform as their new burgeoning business-to-business play, we can clearly see how SoFi's strategy to become the largest fintech company in the world is well underway. But that's just the story SoFi wants you to believe about their business. To really understand what's happening, we need to look into SoFi's latest earnings for Q4 2021, because that will take us from the on-the-ground view of one customer to the 30,000-foot view we need to make decisions as investors. So let's look at what story the numbers are telling. And the easiest way to do this is to go through each of SoFi's business segments separately and then put everything together at the end. So starting with financial services, which includes SoFi Invest, SoFi Relay, the SoFi credit card, basically any SoFi product that we would use as a consumer. They added 857,000 new financial services products being used this quarter, up 56% from the amount they added last quarter and up 155% compared to a year ago, or 2.5 times higher. This now brings the total number of financial services products to 4.1 million. Now, this is again a decline in the growth rate that we've seen over the past few quarters, where we used to see 200 or 300% growth. But that is mostly due to SoFi hitting such a large scale that they can't keep 5xing every single year. Now, normally that would be a problem, except that SoFi is now hitting a big enough scale where they can actually start monetizing their customers better than before. Their revenue actually increased 5 times higher than what it was a year ago, doubling the amount of money they were making per product. Now, this is all part of the financial services productivity loop, where SoFi has made their products so good and so sticky that when a customer is looking for another service to use, like say a credit card, they will look at SoFi's other products before going elsewhere. This has tripled the cross-buy volume for their customers this year, dropping their overall customer acquisition costs by 17% in 2021. It's just like we saw with Kate's story. Once you land a customer with one product, it's easy to sell them to other products that better suit their needs, and it's a win-win for the customer and for SoFi. But using their SoFi app like a top of sales funnel also works for other business segments within SoFi, such as their lending segment. We already know that a customer that becomes a lending customer after already using the app is twice as valuable over their lifetime as a loan-only customer, and that's been helping SoFi's bottom line. In their latest quarter, the lending segment grew its revenue 30% year over year, which actually isn't that high, and for all of 2021, lending grew 42%. Now, we do expect lending's revenue growth rate to be a lot slower than financial services' 5x increase because there's a lot more of it, around $208 million for the quarter and $760 million for the full year, which is around 70% of SoFi's total revenue. But this area was also impacted negatively by the announcement of the federal student loan payments pause being deferred all the way back until May 2022, rather than the original date in December. So overall, not the best quarter for this segment, but there were a few bright spots in the report. While SoFi started out as a purely student loan company, they've diversified into personal loans and home loans as well. And in 2021, they moved from just refinancing existing home loans to re-entering the jumbo loan market. They've managed to increase this to over 10% of SoFi's total home loan volume, which provides some diversification for them amid rising interest rates. And diversification really is the key here. Investors from Cathie Wood to Chamath Palihapitiya have been worried about rising rates and uncertainty from the Fed. And in a lending business, you are super vulnerable to these types of changes. Now, SoFi has survived thus far by diversifying its income into multiple areas, and they should see some tailwinds once the student loan moratorium ends. They're also diversifying their revenue away from just making loans to servicing them through partners like Pagaya. Now, Pagaya is similar to Upstart, which is another company that I own, and they use AI to decide who they want to offer loans to, letting them take risks with customers who might not qualify for a traditional loan just based on their FICO score. Now, SoFi partnered with Pagaya so that if a customer reaches out asking SoFi for a loan who has a bad credit score, Pagaya will pay SoFi to give them the customer info. So SoFi makes money off of servicing that customer, while Pagaya takes all the risk of offering the loan. Now, this is still a pretty small amount of revenue. They only offered 7,700 loans through Pagaya, but when diversification is your aim, I'll take the small wins. But while the areas of financial services and lending are probably the most relevant to consumers of SoFi's products, the third business segment of technology platform, I think, is much more key to SoFi's long-term future potential and ultimately how valuable SoFi's stock is going to end up being. Technology platform includes SoFi's acquisition, Galileo. Galileo now has 100 million accounts, up 67% year over year. Again, a slowdown from the 81% growth they had last quarter, but with 100 million people, you can't keep doubling forever. Eventually, you saturate the market. Now, Galileo made $53 million in revenue, up 42% year over year, and an acceleration versus Q3's growth at 29%. So while their number of accounts are slowly decelerating in terms of growth, they're able to better monetize these accounts today than ever before. In total for the year, Galileo more than doubled their revenue to $195 million. But that number doesn't really paint the picture for how big of a deal Galileo is going to be for the company. SoFi's dream with its technology platform is fundamentally different from their other business segments and frankly different from any other fintech that I've seen. They want to become the AWS of fintech. AWS, if you aren't familiar, is Amazon Web Services, the largest cloud provider in the world that runs a good chunk of all websites, company applications, machine learning workloads, pretty much anything that a company needs to run their business. So SoFi wants to create a tech platform for other fintechs, where those fintechs can build their own applications on top of SoFi's infrastructure of payments products, processing, credit card transactions, and moving money around. This is a B2B business where SoFi's customers are enterprises. They count H&R Block and T. Rowe Price as new partners, as well as apps like Chime and even international neobanks. This makes SoFi more of a tech company than a finance company, and it diversifies their risk away from macroeconomic movements. Because while customers can pull money out of your app if they get mad at you, just look at Robinhood as an example of that, companies are much less likely to stop using a product that they rely on to run the backbone of their entire business. Now, acquiring Galileo was just the first step in the plan, and just last week, SoFi also acquired Technisys, which I made a whole video about. But in short, this acquisition won't be like just adding the revenues of two different companies together. Instead, it will become a force multiplier where SoFi's offerings will become exponentially more valuable to companies over time. It's still very early days here, but just as an example of how powerful this segment could be, SoFi's CEO talked on the earnings call about how SoFi Bank could act as a sponsor bank for other companies. For example, right now, Robinhood has a partnership with Sutton Bank, and Apple offers its credit card through Goldman Sachs. So if you're a new mobile banking app, you could use SoFi as your sponsor bank just to get your regulatory approvals, and then you could also use them as your payments processor, meaning you could offer better interest rates than your competitors using just one partner rather than a bunch. Honestly, this strategy could be powerful enough that one day regulators look at SoFi as a potential monopoly if they were getting big enough and had too much control. But I think if that ever happens, we'll be pretty happy with our returns at that point. So when we look at SoFi as a whole, their members increased 87% to 3.5 million. Again, a deceleration in growth, but still the largest total number of members added in a single quarter. Revenue for the year crossed the $1 billion mark, up 62% year over year, and for their first year ever, the company was profitable the entire time, reporting $30 million in adjusted EBITDA. Not bad considering how crazy the last year has been for the lending segment, but obviously not the same kind of consistent hypergrowth that we've seen from some tech companies. But a lot of what I've talked about in this video is SoFi's past performance as well as their strategy going forward. But let's now take a look at the leadership expectations for 2022. So SoFi expects this to be a much bigger year than 2021 for them in a lot of ways. First of all, SoFi's bank, which just opened this February, will start fully originating SoFi's loans in May 2022, something that I predicted in my previous video covering SoFi's bank charter acquisition. And as a national bank, SoFi will be much more efficient in running their financial services without needing to send fees to a partner bank. And if they're anything like Lending Club when they acquired a bank charter, this should send the stock price soaring. Next quarter, they expect revenues between $280 and $285 million, up 30 to 32% year over year, with very slightly positive EBITDA between $0 and $5 million. Honestly, that growth rate isn't very impressive, but the full year outlook looks a little bit better. For the full year, they expect 55% revenue growth, up $1.57 billion in revenue, and adjusted EBITDA of around $180 million. Part of the reason for that is SoFi's bank becoming an important factor only from Q2 onward, and the other part are 5 assumptions that SoFi's management laid out, which honestly is so nice that they did this because we can now monitor these assumptions to see if SoFi is on track to hit its estimates or if it will fall short without having to wait for their future earnings. Assumption number 1 is that the federal student loan payments pause will expire on May 1st, and that we will go back to pre-pandemic loan volume partway through Q2. Seems reasonable to me. Number 2, SoFi Bank will start to contribute meaningfully to the business in Q2. Number 3, Technisys, their latest acquisition, will have 20 to 25% revenue growth for the year and will add their revenue as soon as the transaction closes. Number 4, they will continue to deliver 30% margins as they invest the rest of their earnings back into the business to drive future sustainable growth. And number 5, we will see 5 interest rate hikes during 2022 that SoFi can respond to in their lending business. If these assumptions are correct, SoFi should start to see improving efficiencies in the business from their bank charter and the financial services productivity loop, while grabbing new customers through their decrease in customer acquisition costs. And that is where you start to see explosive growth at scale exiting 2022 and into 2023. But while SoFi obviously has big ambitions, let's talk about how likely they are to come true. And everything from here on is pretty much my own opinion. Now, I think the financial services productivity loop is real, and while it's fundamentally just cross-selling customers the same way that a lot of successful businesses do, like Amazon or Cloudflare, I can appreciate SoFi's management really emphasizing this as an advantage for them. I also like SoFi's increasing brand awareness, and as they continue to grow, I expect more and more people to become familiar with them, especially now that SoFi SoFi Stadium seems to have become the de facto location for large YouTube videos to film in. Now, as far as lending, this is probably the area where I have the most uncertainty. SoFi is very exposed to interest rate risk because they hold the notes on a lot of different loans. Now, leadership is trying to diversify as much as possible to lessen this risk, but lending still makes up 70% of the company's revenue. So fundamentally, they're vulnerable to whatever Jerome Powell decides to do with his money printer. Also, I'm not particularly experienced in analyzing this type of financial risk, and so this whole area, at least in the short term, is very hard for me to accurately assess in terms of risk. But SoFi is also moving into an area that I'm very familiar with as they develop their technology platform into the AWS of fintechs. Now, for now, they're much more like a Visa network of fintechs, since they just process transactions from other companies rather than letting companies build on top of their platform. But if Galileo and Technisys can truly go from a service SoFi provides to other companies to a platform those companies can build on top of, that could unlock huge growth in the B2B space, which is a company I'd honestly be willing to invest in all on its own. As far as what I'm doing with the stock, I added another 52 shares to my position after SoFi reported earnings, and I'm curious if you've made any recent trades in SoFi as well. Don't forget to like and subscribe, and I'll see you next time.